This video covers material in Chapter 22 where we explore the competition of resources and the cost of production. Production inputs are classified into the broad resource categories of labor, land, capital, and entrepreneurship. Each of these resources are offered to producers of goods and services in markets where firms of various sizes compete to purchase labor and raw materials, which when combined together in a production process contribute to the market supply of those goods or services. In economics, we not only want to know the cost of producing a certain good and the potential profit a firm can earn, but we also want to understand the opportunity costs. By defining opportunity cost, we can reveal to the entrepreneur whether the decisions to invest in a certain activity will yield the anticipated profits or whether other investment activities will produce greater returns. Every firm must account for the financial expenditures and revenues using accounting principles of debits and credits. However, when opportunity costs are considered, the economic accounting provides additional valuable information. When accounting profits and economic profits are compared, the one difference is the inclusion of implicit cost in the economic profit calculation. Implicit costs are the non-monetary opportunity cost of the highest valued alternative that is not taken when engaging in certain business activities. An example of implicit cost for a business would be the foregone interest from a $10,000 bond the owner of a business could have purchased rather than investing the same amount in capital equipment. This chart shows the difference in calculating economic profits and accounting profits. Consider the decision-making process of a bright young student and his new wife when faced with the choice of using his advanced degrees to make a living or satisfying his less stressful bohemian desires to open a pottery shop. The first 5 rows show the accounting for explicit profits, while the remaining 3 rows show the implicit or opportunity cost of opening the pottery shop over the potential returns of his educational investment. The couple may be initially happy that they show a positive financial profit of $12,400. However, when the opportunity cost of what could have been shows a negative $60,600 difference, they may not be as happy. This negative number shows that there is a better option available for the time and the money investment. When managers perform the financial and economic analysis, they must take into account both short-run and long-run timing of their production decisions. In the short run, some resource decisions can be adjusted. These are usually variable costs such as how many hours employees would work and how many units of output should be produced given the available labor and capital machines. In the short run, expanding the plant size or ordering additional capital equipment cannot be made to change production levels. The long run, by definition, is that period of time in which all factors of production, including plant size and acquisition of specialized made-to-order capital equipment, can be changed. The difference between the short run and the long run is not defined by the number of months or years. It varies with the ability to make all changes necessary to meet market demands for the production or the objectives of the firm. Just so we're all on the same page, production is defined as any activity that results in the conversion of resources into products that can be used for consumption. The production function is the relationship between maximum physical output and the quantity of capital and labor used in the production process. The production function is a technical relationship between these inputs, capital and labor, for example, and the output. We define output as the number of units of a particular product being produced in a certain period of time. How much is produced in an hour, a day, a month, or a year? Mathematically, this definition can be written as quantity of output is equal to the function of capital and labor. In this case, we define capital with a capital K and labor with a capital L. There are 2 additional definitions we will be using: average physical product and marginal product. Average physical product is the total product produced divided by the variable input. Marginal physical product is the physical output resulting from the addition of one or more unit of variable factor of production. The marginal physical product is the physical output resulting from the addition of one more unit of a variable factor of production. It is the change in total product that occurs when a variable input is increased and all other inputs are held constant. Fazari is a bicycle manufacturer located in Linden, Utah, and it is a direct seller of mountain bikes, road bikes, hybrid bikes, and bicycle accessories. In this chart, column 1 lists the number of workers that could be hired and the productivity of each worker. Note that the production of one worker is 10 bicycles, while the production of two workers working together is 30 bicycles per day. This does not represent that the second worker is twice as productive as the first, but working together with the separation of duties, the division of labor, the two are more productive. Column 2 shows that increase in production with each worker, and in column 3 the production is further analyzed as the average production per worker. Note that the production per worker initially rises and then levels off. Why do you think that's the case? Column 4 gives a clue by calculating the marginal change in production as each worker is hired. As workers 7 and 8 are hired, the production slows and then drops. Total production is still up when the marginal physical product goes down. The law of diminishing marginal product holds that after some point in the production process, successive increases in some variable factors of input will result in successively smaller increases in output. In the short run, you may hire more workers or increase their hours, but you will not be able to expand the physical capital. If you have 3 machines that fuse the bicycles together and have 3 workers, each will be fairly productive. However, when you hire the 4th worker, both marginal and average production will go down. The 4th worker may be able to help with supplying materials, but will not have the productive capacity to produce on the same level as the first 3 workers. When graphing the production of the Fusari bicycles, there are significant increases in productivity with each additional worker. But at some point, more workers cause the productivity to slow down and the marginal product to decline. In the short run, the firm has the ability to change the variable inputs. But at some point, the fixed inputs, the capital equipment, the factory, and the machines, reach maximum capacity, and additional variable resources become less productive for each unit that is produced. The marginal product of labor may increase very rapidly at the beginning with the specialization of job duties and the ability for one additional worker to leverage the productivity of other workers. Again, the diminishing productivity of the firm as more workers are hired is not because the newest workers are less skilled, but because each worker has fewer capital assets and space to work in. To help understand the relationship between marginal and average values for a variable can be illustrated with this examples of members of a track team. Calculating the total weight of the team members, we can see that total weight is 705 pounds, and the average weight of the initial team is 117.5 pounds, calculated by dividing the total weight by the number of team members. The coach decides to add former jockey Waverly as a long-distance runner. With Waverly on the team, the average team weight goes down, even though there would be one more team member. Now the coach decides that rather than including the long-distance runner, the team has a greater need for a shot putter and adds former sumo wrestler Takamiyama, better known as Deegan in the U.S. The marginal change is 350 pounds since that is both Deegan's weight and the marginal change in inputs. The team total weight increases by 350 pounds to 1,055, and the average is now 150.71 pounds. Note the unique relationship between marginal changes and changes in average values. When the additional marginal change is less than average, the average value goes down. And when the marginal change is greater than average, the new average will be pulled up. The addition of more workers eventually yields successively smaller increases in output. At some point after adding more workers to existing capital, the firm will reach capacity output and each new worker on average will be less productive. The marginal physical product of each labor unit added, given a fixed amount of capital, will eventually be less than the marginal physical product for fewer workers employed in the production process. The information in this table can be used to calculate Giovanni's pizza operation and his marginal cost and average total cost. For the first 2 workers hired, the marginal cost of labor is increasing. With the first 2 workers, the marginal cost per pizza goes down. Hiring the 3rd worker predicts that the marginal product of labor will decrease, and that by adding more workers will cause the productivity of labor to drop dramatically. Why do you think that's the case? With a drop in productivity and increased cost of labor for each new worker, the marginal cost per pizza increases, as does the average cost of pizza. Graphing this information, the marginal cost curve falls with the first 2 workers and then rises, taking the look of a U-shaped curve. As long as the marginal cost is below the average total cost will be falling. But when the marginal cost is above the average total cost will be rising. This relationship between the marginal cost curve and the average total cost curve explains why both curves will be U-shaped. In this chart, suppose that you own a printing shop. Here you have your number of workers, your fixed cost, your variable cost, total cost, your average cost, and marginal cost. Stop the video, take a few minutes, and see if you can follow the calculations that complete each of these columns. We expect that average total cost and marginal cost will have a U-shape. Both curves fall and then rise as cost per unit increases with the full utilization of fixed resources. At the beginning, all resources have excess capacity, and using the idle capacity takes advantage of economies of scale. This is the result of both average total cost and average variable cost having the U-shape. The marginal cost curve cuts through each of these curves at its minimum point. Since both average total cost and average variable cost follow the marginal cost, the vertical sum of the average variable cost and the average fixed cost curve is the average total cost curve. In this chart, I have provided a summary of the defined terms. Take a few minutes and study these definitions. We'll talk more about this in class.